Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at Trade Stations. Great to be with everyone. Showing some disclosures to start. Just let me know if the sound is okay. I saw a little strange thing when I started. Someone could please just respond in the comments section. I had a strange thing with the sound when I just started here. I think it's okay, but want to just make sure. All right, putting some disclosures in there for you. And all right, not seeing any response yet, but I'll go ahead. All right, S&P pushing back toward 5,600, and it's interesting because, in some ways, I think the kind of strength that we're seeing here in the market is really much more a question of a process of the overall bullish market playing out more than it is the response to any individual event. Okay, I'm going to my TradeStation platform. Start with some of our standardized returns. We do talk about ETFs in this. We use them sometimes for indexing and for kind of relative performance measures. And I want to make sure that you guys can see these. Also, we are providing the disclosures. The prospectuses are available in one of the links we just shared. Can someone please respond to me in the comments just so I know you can hear me okay? I think we're okay, but I want to just make sure. All right, so let me just proceed now. All right, so I want to kind of tell you guys, as usual, if you go to tradestation.com to begin and you click on Insights, it'll take you to our, our blog. And right here, this is the summary of things we're going to talk about today. I do want to mention that we did this article yesterday morning. We wrote it on Tuesday afternoon and it went out Wednesday morning. And it more or less was talking about the positive forces building in megacap technology companies and in the NASDAQ. And things have played out very much as we had kind of outlined in this blog post. It's kind of interesting when I kind of check it out, how basically a lot of positives are building in Tesla, NVIDIA, Amazon, and some of these other companies. And we're also kind of at a spot here where, I kind of think that we're going to get to it, but the dovishness might have gone as far as it can for the time being. So this is the actual blog post we're working on. Now, I wanted to actually let you guys know also that I am going to be in Miami the week before Thanksgiving at our Crossroads Summit. There's a link to it right here. And this Crossroads Summit is sponsored by TradeStation. And the website is crossroadssummit.com. And there's going to be some really interesting speakers about the changing trends in the world of business and economics. And I'll even be interviewing some of them. So hopefully you guys can make it. It's November 21st and 22nd at crossroadssummit.com. There's also a link right here if you're interested. Also, we will be doing State of the Market on Monday. And go ahead and you can sign up for it right here. And I'll mention, if you go back to our State of the Market, the Monday we just had, we had talked about the developing strength in the consumer discretionaries. And I want to just kind of point out here that if you actually look, it's interesting to see the consumer discretionaries here, the XLY, for example, are breaking out of this kind of tight pattern. And I think it's kind of interesting because, Tesla has the robotaxi event reportedly coming up next month, and I think that's an important kind of thing. But I want to just go through a few things. First, got to start the S&P 500. If you look here at the actual, right here at the chart, there's some very interesting patterns here. I'm going to very briefly touch upon. But to me, what's kind of most interesting here is the fact that, there's a lot of things interesting, but look at this candle from August 1st. This big bearish day. That was one of the biggest daily ranges in a long time. We talked about it at the time. So it was a pretty violent reversal. And we mentioned, we were doing a market trends at that time, we mentioned the fact that it created a downside risk in the market. What's interesting is yesterday, we almost exactly did the same candle. I mean, it's incredible. The range was almost exactly the same between 5,400 up to 55 kind of area. And it's interesting how the top of that candle, 55.60 area, was support for 2 weeks in a row. Once we broke down under it, we had a period of weakness, and then boom, we got right back above it. We touched it yesterday, and now we went under it and broke back above it today. So it's interesting to see these levels. Another thing that's very interesting to me is we look here on our drawings and we go to Fibonacci price retracement lines. If you just look at the move from this low to this high here, you can see that we more or less held half of it. Now, there's different ways to draw this line. There's, I would say, if you more conservatively from the open back there on August 5th, you can actually see that we still held half of it. So we held half of that move, and it's interesting just to see the fact that we're holding above this level, and the key thing is down at 5,400. In fact, kind of depending where you draw, but we have this line here that goes back right around 5,400, back from June 13th, and then we have this period of consolidation here right around that same area. And then you also see how we slammed down to it on Friday, tested it yesterday, and held this giant engulfing bullish outside day. And then the continuation today. So from my perspective, this kind of, everyone knows that September allegedly is bearish. The last 4 Septembers have been negative. We have all these sort of seasonal things and scaries and all this stuff that people talk about. But the thing here is that that sentiment or that force might have played itself out, and this might have been it. Because I think when you take a step back now, you got to realize that we're in a situation where we know that the inflationary process is moving in the right direction. Now, it's possible. There are some signs, to be honest, in 5 to 6 months, we're going to see inflation come back. But the fact is the market's not going to focus on that now. The service inflation, the housing inflation, stuff like that. You could see some of these things remaining in effect, maybe lingering more than people want to see. But the market's not going to think about that for right now, because right now, Fed funds well over 5%, CPI, under 3%. We're at a point now where our policy is restrictive. So, 50, 75 basis points, the Fed has that space to do. And we're in that spot now where it hasn't happened yet. So at this point, these things are playing out. And so I think we're in a spot where we're going into a series of rate cuts the way the market expects it. And we got to remember, last earnings season, 200 basis points higher than expected of earnings growth. We're back to double digits expected this year and next year on the S&P 500 earnings. Then you have NVIDIA. Basically, I got to say, go to the Goldman Sachs conference, go to the NVIDIA Investor Relations website, and look at the Goldman Sachs conference yesterday and what Jensen Huang said. I mean, it was a fascinating interview, and he basically confirms everything's happening with Blackwell chips. They're going to be shipping on I don't know exactly schedule. He hadn't really said what schedule is, but the thing is if there really was a substantive problem with these Blackwell chips, they would have had to disclose it. And at this point, it's one of these things where you see this big, kind of horizon opening up in front of us in terms of the kind of demand and the use that there will be for these sort of products. And it has run. But the thing is, when you look out, there are areas where we could be really still in kind of the middle of this expansionary phase in these large growth. And so the thing is, it gets to this point when people look at that and they say, where are we going to be in 3 to 6 months? They look at the end of year seasonality. They look at the Fed cutting rates, all these other things that are, that are out there. And it gets to a spot when it's hard to stay on the sidelines. And I think that's what we're seeing now, because negativity keeps going up. S&P 500, was it S&P Global today reported that negativity was the highest in over a year. If you look at things like the AAII survey, it's been getting more bearish in this phase here. So the problem is that tells you that basically the money is on the sidelines. People are in cash waiting. They're not overextended. They're not over leveraged on the long side. So what does that mean when you can barely pull back, when you basically hold support, when you hold the 50% retracement of the previous month's move? What does it tell you? It kind of suggests here that the sellers are not very numerous. The potential buyers outnumber them. There's cash on the sidelines, and the runway ahead of us with rate cuts and double-digit earnings growth expected, and Blackwell on track, robo-taxis coming from Tesla. You put all those things together, and it gets more difficult to really build a case for remaining on the sidelines. And the problem here is that, yes, we're in a month where the textbook says the market's going to go down, and everyone says that, but at the same time, the entire cycle going into presidential elections, I think going back to 2012, I mean, even in 2008, but that was crazy because that was 2008. But all these, if you look at them, the period of September, October, November into that election has been weak. All these elections in I think in 12, 16 was, 2020 was. And so the question is, does history just keep repeating, or when people know something and then everyone's positioned the same way? I think that's really kind of what the the thing here we have to realize is that might actually be the risk, is that everyone is just piled in kind of on the caution side. And then when the other shoe doesn't drop and the worst case scenario doesn't happen, then you get into that spot when people are forced to kind of chase potentially, and that's kind of one of the things that the market can do sometimes. So want to also now, just this is a little thing I just created, but this is, I use the high-low range custom indicator that I'm giving you guys. It's in the zip file. If you actually go here, it's in this zip file that you can get here, downloads available here. But what's interesting is yesterday was the biggest basically range. This shows the range in percentage and in points. And you can see that, negative days are often bigger. The biggest moves happen usually on bearish days. But this was the biggest green candle yesterday since back here at the bottom in October of 2022, when we had that bullish outside reversal on a CPI report. And basically that was the bottom. That was the end of the bear market that happened in 2022. It was that candle right there. And so yesterday we had the biggest candle, the biggest bullish candle. Doesn't mean the biggest gain, the biggest range of the low of the candle to the high of the candle. We had the biggest range, since that time. That tells you some significant stuff. And I think we're seeing here is the market tries to go down and there is no follow through. That's what actually these candles are telling you. When it goes down and it basically fishes down, the tail goes down and there's no follow through, and then boom, it goes back the other way. And I think this is what I'm talking about. There not being a lot of sellers. So, all right, that was something I wanted to mention. Now, want to show you some of these other patterns here that were kind of interesting to me, where I'm seeing this pattern popping up. It looks something like Broadcom. This pattern is popping up in a lot of different things. Wait a second. I had drawn some trend lines on this one. I wonder if I lost that. Basically, let me see, I just draw this trend line. But basically, falling trend lines all across some of these different charts here. Things like Broadcom. Also, things like the NASDAQ itself. So there we go. I drawn something. This one I've forgotten to save. But anyway, so we have this sort of these downtrends that we're just kind of breaking out of them. And again, I think this is one of these things that we've seen here where the sellers they came back and they were not able to push as hard the second time around, and now it just kind of leaks. It has this thing when it can't stay down, when there's more money on the sidelines. And that's what this pattern looks like. And we've seen this before at other times. This moment almost reminds me of March 2023, when everyone was freaked out about the regional banks. And then suddenly NVIDIA started running, and suddenly the NASDAQ started breaking out. It's not to say that it's necessarily the same, but it's the same thing of like, there's a lot of negativity, but then there is no follow through to the downside. And then before you know it, things start kind of turning. So, all right, wanted to mention that. Now let's look over here we're looking at MT Main. Look at the key ETFs. It's pretty interesting here to look at the, this is how we use MT Main. It basically allows us to see sector performance over a different time frame, which gives us a sense of how things are rotating. Look in the last 21 days, which is a month. You can see here that technology is actually underperforming the S&P 500. But in the last 5 days, it's the leading. And then, so you can see here is consumer discretionaries. You can see consumer discretionaries. These have actually been doing pretty well. That's the one I mentioned before. The key thing I want to mention here is that tech is coming. And look at how in the last month, communications are weak. They're unchanged in the last month, the XLC. But today, they're leading. So today, look, technology. And look, basically, what are we seeing? XLC, XLK, XLY. Those are the mega caps. Those are our three sectors that are dominated by NVIDIA, Apple, Meta, blah, blah, blah. That group is concentrated in these three ETFs. And so basically they were lagging over the summer. If you kind of look at like a 63-day, which is a 3-month out performance, you can see here technology lagged, communications lagged, and consumer discretionaries were actually better. but all that move also you can see came in the last month. The key thing is that now we're starting to see that rotation back, and that's what we're getting here from our from this workspace. It's telling us that we're seeing that money go back to the large cap growth. All right. Now, I also have this MTES workspace I share with you guys. And what's interesting here is I wanted to show you that this gave a potential buy signal yesterday and today at more or less at the lows. So this is something we use that when the moving average, the 50-hour moving average of the futures is moving higher, you can basically you want to have 2 of the 3 signals potentially pointing in the same direction. Stochastic going oversold is a bullish signal. The 50-hour was rising. That's a bullish signal. So what's interesting here is that MACD was just flat, but then basically you can see, wait a second. Yes. No, I'm sorry. This was the part. I'm sorry. This was the spot right here. So stochastic was oversold. And at this point, the 50-hour moving average was rising. That was a buy signal. Here this morning, or right around noon, around 10 or 11 this morning, stochastics went negative and the 50-hour was rising. That was a buy signal this morning. So I want to show you that this is something that remains kind of interesting. It's a kind of simple sort of use of the S&P futures with these indicators. It has MACD, stochastic, and the 50-hour moving average direction, which is a custom indicator we've included. And these are in that zip file as well. But I want to just mention that these were both signals that popped up based on that. Okay. Now, let's look at this other. This is a workspace I don't share because I work with this one a lot and I'm always changing it. But this is a little something I did to kind of show these are monthly time frames here. I'll hide myself in this one. Just kind of you can kind of see this better. The key point about this is if we actually look, this is the performance in the first half, and this is the performance in the second half. What I did is I go to 2 period changes. Now notice I'm using monthly, so you select all, and then you do your time frame. In this case, I set it to monthly. 2 period changes, a custom study I've given you guys. If you go in here, you go to studies. I've set it to the inputs are 9 and 3. So it's going to start 9 months ago, and then our period, our second period begins 3 months ago or 3 candles ago. So this telling us is 9 months ago, we'll basically go back to the beginning. It'll basically go from December 31st through June 30th. It'll look at the performance of 9 months ago to 3 months ago, which is the first half. And then it will show us from 3 months ago to the present. And it will treat September as a full month. Even whatever September's at, it'll say that's September. So basically, this is telling you like REITs are up 8.27% this month. That's a 1D. Anyway, so the thing is this is going to look at the performance. So you can see is essentially current return is the more recent integral. So what do we see? We see that real estate, utilities, consumer staples, these have been the ones that have been outperforming. And then you can see that there we have technology and communications, which are like year to date, 2 of the leaders. Those have been lagging so far, this half. So it just this allows you to kind of easily visualize, just to kind of see that performance in the shift. But now what's interesting is I'm going to select all and I'm going to change it to weekly. And you're actually going to see, now this is going to show that the calendar week, which is actually, 3.5 days from last Friday to this moment now on this week. Over here, when we do MT main and we do 5D, that is our trailing 5 days. So it's not a calendar week. It's a trailing week. Over here, the way I'm doing this, we'll use the candles as weekly candles. I'm going back now to MT blog. But what is it showing us? It's basically showing us on a week to date basis. What do we see? A massive outperformance now of technology just surging back to life. So technology has been lagging in the second half, but suddenly this week it's jumping. So these are just some interesting ways you can see this pivoting happening. And when you look at the candles of some of these things, you look at something like, financials had this bad sort of news when JP Morgan came out with, saying people were too bullish on their, numbers and things and whatever. I mean, the thing is that this value trade, we have to be careful because, the value trade works for a while, but then at the same time, it has this tendency to kind of, it runs for like a certain number of weeks and months, and then suddenly the money rushes back to tech, and the value names just they die and they sit. So I think the thing is financials, utilities, all of these, they've had this strong move. And the question though is does it really continue? On market trend, a state of the market on Monday, we have talked about, this is now the weekly chart, but we've talked about utilities getting back near this weekly high. I think we got to realize that the utility ETF is back near that high from September of 2022. So, a lot of these things, people feel clever and they, make money in things like utilities and all that stuff. And it works for a while, but also just kind of realize that this is something where, at a certain moment in time, it might be kind of near a high. And then suddenly people say, wow, NVIDIA is, well off its high. And where do I think is going to outperform for the next, 2 to 3 months, utilities at the high or NVIDIA coming off the lows. And so I think that's actually where we are right now, where people are resetting back and saying what's going to outperform in this period as we go into the home stretch of the year, as we go toward first earnings season, then the election, then year end, all those things together. Are utilities going to outperform chips? I mean, maybe, but I think a lot of people, when they kind of take a step back, that might not be what big money managers really believe. All right, so those are the things. And I would just say here that it's just interesting to I think just recognize that those three ETFs, XLK, XLY, and XLC, are now kind of coming back to life. And it does show that we have that sort of, bounce back to the mega cap growth. All right. Now, if we look at the other things in our blog post here, we had kind of mentioned that, basically, well, one thing I think I also want to mention is that we're not getting a follow through with the yen being weak. And one of the other things I wanted to mention, the yen being strong, like the dollar yen, this was something to me that was just kind of out there. And, the ECB today cut rates, and then the euro is not crashing against the yen. So whatever it is, this crisis, if we were in a bear market, then, you would probably be seeing the yen shooting higher, but it's not. So I think it's just, this remains to me the indicator we want to kind of watch and be aware of. Now I I've been noticing here the strength in gold miners. Something is not a surprise when you consider entering a rate cutting cycle and everything else. And then, I don't know what to think about gold miners to a certain extent, because part of me is a little bit, unsure when you think about something like, the thing is I think we have to remember that we're in a secular bull market for stocks. And we also have to remember is that basically the economy here is not in a spot that has any kind of recessionary thing. The other thing I think that, there's no, at this point, it's hard to really argue about a recession being in play. The other thing I'm slightly viewing as a potential risk is the fact that these are the 10-year treasury. And I'm just watching this here. And, we have said that it has downside risk down to 3.25. But at the same time, it does have a way of playing like kind of mind games and sell the news and everything else. So the question here with the Fed coming up and everything else is, I'm watching this, and there's part of me that looks at this when we actually look at things having extended a certain way. I think that there is something of a risk here of yields reversing higher. And that would not be necessarily a good thing for gold. And it also that would be, if anything, a positive for mega cap tech. That's some of the correlation we've seen, is that when yields kind of move, not shooting higher, but the fact is that, if people are no longer focusing on rates going down and they're focusing on mega cap growth, that environment usually does not correspond for bullishness in gold, usually does not correspond to interest rates continuing lower. So at this point, I'm just kind of like watching this as a potential risk. I want to mention it's interesting to see what's happening with gold miners, but also there is a lot now of expectation priced in of the dovish Fed. And it was just kind of interesting to me to see how it's trying to kind of, hold around this level. And it's not to say that yields are going to go higher for a long time. It might simply be a case of some, kind of consolidation and moving around here, and the straight move has kind of potentially happened for now. But the other thing is that also, what does that mean for utilities? What does it mean for real estate? What does it mean for consumer staples? These things that have done so well. And the thing is this might also be a question of, if yields move somewhat higher, there could be rotation from those back to the large growth. All right, so let's see. Another thing I want to actually say is I'm actually increasingly annoyed with the concept of breadth at all. One of the things I showed you here about this, this, I call this sector-based internals. It's like there's different ways to do internals on the market. Look at the things happening beneath the individual price action and looking at, internals of the market. I have to say that I am really annoyed at the advanced decline line, because basically the advanced decline line confirmed the market right before it sold off. You had a new high right there as it was crashing, as it started selling off. It made another new high like literally the day before the S&P 500 crashed. And basically here it is making highs right before the market crashes. We've seen this really since early 2022. And the key thing is that in a mega cap dominated market like we have now, breadth is bearish, because it basically means money is moving away from the leadership groups. So I want to just mention here that as we look at market internals, this sector-based approach that I'm showing you here might be more effective, at least for the time being, than the traditional advanced decline line, stocks making new highs. I've just found this to be not accurate. I mean, it just has not really given. I mean, look, stocks making new highs, and then guess what? That was when the market started selling off. So I want to just mention that using MT Main, the way we provide it, looking at the different time frames and seeing how the different sectors move and turn, actually, in my view, is giving us a better understanding of internals. Nothing is always true in finance or in trading. And the fact is, there was a time when the railroads and transports told us what was happening. Now, transports are basically this obscure, irrelevant little index that no one talks about anymore. And Charles Dow had a point in 1890. But the fact is that if there's anything that now should replace transports in Dow theory, it should be the semiconductor index, maybe. So my point is just that things are changing, and the real point of breadth is to do internals on the market. And there might be a better kind of internal analysis, and that could be the sector-based approach that we're able to do here with TradeStation's award-winning platform and radar screen and some of the custom indicators. Now, I also want to just mention that to me, it remains very interesting to to mention that we had done this article back on the 15th. I outlined how sentiment was so insanely bearish given the the actual reality of unemployment and inflation compared. We talked about how sentiment was equivalent to 1982 when unemployment was over 9% and CPI was over 6%. So basically sentiment is super bearish right now. And tomorrow we get another consumer sentiment reading from the University of Michigan. My expectation, not my expectation, but the trajectory we're seeing, and we saw this last month, is that sentiment is getting better. And my perception is that there is an overwhelming amount of negativity in our country about politics, about the economy, about everything. And the thing is that as if this trend that we saw last month continues, and people start to say, "Wow, gasoline has come down a lot, and the Fed's cutting rates, and blah blah blah." If we start to see a steady improvement in sentiment across the population and everything else, that's another thing that could potentially be a positive for equities. So I want to just kind of mention that. And those are the main things. I have a bunch of a potential kind of chart patterns that I thought were interesting to kind of look at. We put up Mercado Libre today. It followed through to the upside. It's really interesting to me to look at Meta here, because Meta basically it was just asleep, and then basically today it just jolts to life. Look at how it was just sitting there, and then it just jolts to life. Kind of Microsoft, the same thing. It's just these squeezing, descending, almost like they're not quite descending wedges, but it's like it just grinds down and then suddenly it just jolts to life. Big tech has a tendency to do this, as does Bitcoin, by the way. I've noticed that this pattern I actually noticed more in Bitcoin, and now it's actually appearing in large cap tech stocks. There's other patterns when it happened. I mean, probably actually back here, you could say it was the case. So I wanted to just kind of, emphasize that we're seeing these grind downs and then these kind of breaks higher. And we have a bunch of other patterns to look at. Like, honestly, I look at something like AMAT here. It's kind of interesting. Look at this double bottom. And what's really interesting to me about AMAT, it makes this double bottom above last year's high, basically where the year ended. So it goes back to giving up most of its gains for the year. And I just wonder, a name like this, is this something that has momentum into the end of this calendar year? So that's basically the main things I wanted to cover today. So we will be back again next week. But remember, we will be with you guys on Monday on State of the Market. And remember to go ahead and check out crossroadssummit.com. And hopefully you guys can come down to Miami right before Thanksgiving. It'd be great to meet some of you. I will see you next week. Have a great one.